The Schwab U.S. Dividend Equity ETF, ticker SCHD, has become one of the most polarizing investments in the retail space. Over the past 3 years, it has significantly underperformed the S&P 500, the Nasdaq 100, and even many of its dividend-focused peers like VIG and DGRO. Covered call income funds, such as JEPI and JEPQ, have delivered far stronger total returns in the same period, prompting a wave of investors to declare SCHD dead money and rotate out. That harsh verdict, however, misunderstands what SCHD actually is. SCHD is a passive ETF that tracks the Dow Jones U.S. Dividend 100 Index. The index selects companies with at least 10 consecutive years of dividend payments, strong cash flow to cover those dividends, high return on equity, and consistent dividend growth. Critically, it is market cap weighted and rebalances only once per year. By design, it excludes the vast majority of the high-flying growth and technology stocks that have dominated market returns since 2022. Names like Nvidia, Apple, Microsoft, Meta, and the rest of the Magnificent Seven simply do not qualify. Strip those mega-cap growth stocks out of the broader market, and the remaining 493 names in the S&P 500 have delivered returns remarkably similar to SCHD over the past 3 years. In other words, SCHD is not broken. It is faithfully executing its mandate in an environment that has overwhelmingly rewarded a narrow, growth-heavy segment of the market. The fundamentals remain exceptionally strong. The expense ratio is 0.06%, among the lowest in the industry. The current trailing yield sits above 3.7%, with forward estimates approaching 4%. Over the past decade, the underlying dividends per share have grown at an annualized rate of more than 10%, comfortably outpacing inflation. The portfolio holds roughly 103 blue-chip companies, diversified across financials, healthcare, consumer staples, industrials, and energy, with energy exposure now nearing 20% after the 2025 reconstitution, added names like Halliburton and ConocoPhillips. That energy weighting is particularly noteworthy. The explosive growth of artificial intelligence is driving unprecedented demand for electricity. Data centers powering large language models and generative AI workloads are projected to increase U.S. power consumption by hundreds of terawatts in the coming decade. Natural gas, in which several SCHD holdings maintain massive reserves, is expected to be the primary bridge fuel, while nuclear and renewable capacity scale up. These positions are currently trading at depressed valuations relative to the broader market. Long-term performance tells the same disciplined story. A $10,000 investment made at SCHD's inception in October 2011, with dividends reinvested, has grown to more than $50,000 by late 2025, an annualized total return of approximately 12%. Even an investor who began dollar-cost averaging at the absolute peak in early 2022 would still be up roughly 18% on price, plus several additional percentage points from collected dividends. SCHD is currently experiencing its longest stretch of relative underperformance against the S&P 500 since inception. History shows that such regime shifts, growth dominating value, then value reclaiming leadership, happen cyclically. When the pendulum eventually swings, portfolios heavy in quality, cash flow-rich dividend growers with low debt and wide moats tend to lead the recovery. In short, SCHD is not a total return chaser built for the current speculative cycle. It is a low-cost, tax-efficient engine designed to deliver growing real income and solid compounded returns over decades, particularly for investors in or near retirement who prioritize cash flow over capital appreciation volatility. For those with a long horizon and the patience, it remains one of the highest conviction core holdings available in the ETF space. What do you think of SCHD? Let us know in the comments, and thanks for watching.